I'm going to wait, Tom, until I see the participant kind of. Hi, everybody. We are just giving folks a second to get on the Zoom, then we'll start. Okay. I see a good handful of folks have joined us. So good afternoon. My name is Sarah Ponder. I am a regional director with Dimensional Fund Advisors. I live in Austin, Texas, and I attend St. David's, attend obviously being, a relative word these days. But I attend St. David's Episcopal in Austin. I have for about 8 years. Love it. And I'm really pleased to be joined here by one of Dimensional's clients. I'm an advisor, Tom Post. I'll let him introduce himself as well.
Sure, Tom Post here, lifelong Episcopalian. Currently live outside of Detroit in Bluefield Hills, Michigan. And I've been an investment advisor for 27 years. I'm a partner in a registered investment advisory firm. We have about $1 billion under management, and for a variety of clients, we manage that money, including the Episcopal Diocese of Michigan and their Growth and Income Fund. And I've been a client and investor with Dimensional for that entire 27-year period.
Great. Thank you so much, Tom. I have a couple of housekeeping items before we jump into this, and I missed a key point of my background. I have been at Dimensional about 4 years, and before that, I was in teaching and in nonprofits doing financial literacy for various children and constituencies in schools. And what I do at Dimensional is I work mostly with small to mid-sized nonprofit foundations and endowments across all types. So some churches, many non-churches. So the framework that we're going to go through today is really just some things that we have learned from the market. In fact, I'm going to share my screen. So Tom, give me a thumbs up when you can see that.
I can see it, Sarah.
And one other logistical note, I have a laptop with my screen, and right behind it is a mirror of a much larger screen. So I apologize if I am constantly going back and forth between the two. So what Dimensional does, Dimensional is an asset manager. We fundamentally believe in low-cost, broadly diversified portfolios, both screened and non-screened. On our next webcast, I think will be maybe in mid-September, we'll be going into fossil fuel divestment and that type of thing. That's not the focus of today. The other big housekeeping thing to know about Dimensional versus Tom's organization is Dimensional does not provide advice. Tom's organization does, but that said, we can refer you to local folks or to others who may be closer to you and may know you a bit better. So with that, let's hop into the agenda. So we will spend maybe 10 minutes or so talking about markets in 2020. Then we'll talk through some fiduciary best practices. This includes things like investment policy and spending policy. Tom will have plenty to say about that as he helps to manage the Diocese of Michigan's funds. Then we'll talk a little bit about asset allocation broadly and cost considerations. So with that, if you do have questions, put them in the chat. Right now, I'm not looking at them. I will probably go back and pop out of the screen after a few slides to see if there are any questions. With that said, Tom, if you see any, then jump on in.
Got it.
All right. So I want to start with this framework. So we believe, both Tom and I and all of the other advisors that we work with, that not all securities have the same return, and that prices are liquid, they incorporate all available information very, very quickly. This matters a lot in 2020 because 2020 has been quite bonkers, as we all know. We know that, one day things can be down, another day things can be up. And a lot of folks have wondered, what to do with that. And so I wanted to start out with this, simply to give folks an understanding that we don't know what will happen in the future. We just know that there are hundreds of billions of dollars traded every single day, and that all of those folks participating in the market are coming to fair values, but that different areas of the market do have different expected returns because not all securities are the same. So that's the framework.
And I'll stop you right there, Sarah, in the sense that this year, since sort of the COVID calamity started at the end of February, we've actually seen a huge rise in volume. So not only do those trades happen daily, but they happen with even more frequency. And that just tells you that price discovery is happening. Yeah,
exactly. So every year, we have a slide. We didn't put it in this one, but every year we publish the average daily trading volume within global equities, and it's typically somewhere between $400 and $500 billion of daily trades. I'll be very curious to see how 2020 shakes out. At the end of the day, I think both of us think it'll probably be a lot higher. And as we know, I'm sure many folks that follow the markets know that the volatility was even higher than we ever saw in the global financial crisis. It's been much higher than we've seen in most of my lifetime. So very quickly, what actually happened in the last few quarters? Obviously, Q1 across the board in equities was broadly negative. Much of that, of course, in late February and March. In fixed income, we saw the US was still at about 3%. We saw that developed markets outside, global ex-US bonds outside of the US were roughly flat. And then, of course, we saw a reversal of that in the second quarter of 2020. This really just underscores that there's a lot that we cannot control. And that said, the framework that Tom and I and everyone that we work with brings to all of this is quite simply that since we don't know what will happen in the future, it's very important for us just to control the things that we can control, such as asset allocation decisions, investment policy decisions, spending policy decisions, and of course, cost. So those are the things that we'll be focusing on today. Tom, any questions or thoughts so far?
Well, it's interesting, just the old notion that if you go down 50% decline, you got to go up 100% to get that gain or that loss back. And while the downturn was less than the upturn in the third or the second quarter, it's because those downturns are even more painful than the upswings.
Yeah,
percentage-wise.
Absolutely. So I know there's been a ton of conversation around equities. I wanted to share a few numbers around fixed income, just because it's probably a little less covered. And I apologize to those of you who are looking at this and thinking, oh my goodness, this is a lot of numbers. Let me break this down. So this is from the first quarter. This is the US fixed income market as shown by the Bloomberg Barclays US Aggregate Bond Index. So first of all, the US bond index is 41% of the global bond index. So keep that in mind. There's still 60% of global bonds outside of the United States. The lighter green represents the segmented return. The darker green represents the weight of that segment within the index. So for example, the total index has 42% of US government bonds, 28.5% of corporate bonds, and about 30% of securitized. That means mostly mortgages and that sort of thing. You add all three of those dark greens up, you get 100%. 1 month US Treasury bill total returns was 0.37%. The entire index was 3.15. And I want to go back 2 slides just to show you where that matches up. So that's where this right here comes from. The way that this breaks down is by maturity. So as you move toward the right, you have longer bonds. And as you move down, you have bonds that have lower credit quality. So you can think, your governments and, US government's way up high and corporations lower. So in normal times, what you see as you move from left to right is an increase. So you typically will see that if you are lending money to an entity, whether it's a government, a person, or a corporation, you expect that if you are lending that money for a longer period of time, you'll get paid more for it. So you'll have a higher yield. You do generally within US governments see what we call a positive term premium. That's the 3.76 moving up to 20 plus percent. Then within the corporate markets, you see something very strange happen, which is that there are more negative. There's a negative term premium for the longer periods of time here. And you see that as the credit goes down, there's a negative yield there as well. So this is abnormal because typically if you lend money to a entity or individual or organization, typically if that organization has lower credit quality in normal times, you charge them more. So you would get a higher return. In this particular quarter, we saw that the opposite was true, where the highest returns were the long-term US government bonds, and effectively the lowest were the double B. That means that the top of high yield corporate bonds. Any thoughts, Tom? Anything else?
Well, to me, this is just a classic illustration of what the talking heads on CNBC like to call a flight to quality. So in March, when everybody was very concerned that the world was going to come crashing down, they mostly wanted to own US government debt because that was the safe haven. And they were selling things that like triple B bonds. And there was some worry that there had been, an overhang in the corporate credit markets, and so people were dumping them, and that was driving prices down and driving the prices up of government debt. So it's not too dissimilar to things that we saw in 0809, but probably more extreme, or not probably, definitely more extreme, and perhaps if the Federal Reserve didn't step in, we might have seen, even more extreme numbers.
Yeah, absolutely. And of course, the reversal of that happened in the second quarter illustrates the point that there is not, we cannot individually control how these markets are moving. We do know that prices incorporate all of that available information extremely quickly. And so as, of course, the second quarter moved on and there was a bit more positive news, or there was more economy opening, who knows how that is going to play out, obviously, in the third quarter and beyond, then you see that reversal where the US government yields were very low. And then you're seeing generally positive towards the mid to lower credit corporate bonds.
Yeah, and Sarah, just a small thing to pick on you for. I mean, that you're really meaning to say total return, right? Because this is price change and the coupon.
Yes.
So it's really the total return happening in each side of those spaces.
This is why Tom provides the advice. Okay, I'm going to not spend much time on the global markets. I am just this will be in the follow-up slides, so folks can take a gander at them as well. Suffice it to say, though, Dimensional's position and the position of all the clients that we work with about 3,000 or so advisors around the country. Tom is but one of them. We generally all believe that having a globally diversified portfolio does help to add additional hedges, and it provides additional opportunity around the world. But y'all can dig into this on your own. So all that is to say that volatility predicts volatility, but it does not predict returns. So let me break this down. On the top, in the, I'm going to call it yellow-green, I don't really know what color that is, you see the volatility of what's called month T, so that means current month, and then going up, you see the volatility in the next month, T+1. So as you can see, is that there is a direct positive relationship between there being volatility now and there being volatility next month. On the bottom, though, and out towards the right, you see the most volatile months pointed out there. On the bottom, you see returns. So what you don't see is a positive relationship between volatility and returns. So essentially, it's volatile now, it'll probably keep being volatile in the short term, but that does not necessarily mean that returns over time change.
So when people were panicking in March, it doesn't, a negative outcome doesn't really necessarily imply that you're going to have additional negative outcomes.
Yeah.
The one thing we can say from looking at this chart is that when you have months like March, you're likely to have a continuance of that volatility going forward.
Yeah, and all the numbers before make that very clear. So that said, the good news of this slide is that in general, the markets do tend to return after large declines. The bad news is that, well, I don't know if this is good or bad news, but there's not a ton of observations. So you can see there's just a handful of observations of these big market declines over the last 90 years or so, 95 years or so. But in general, markets do come back. However, every time is different. We don't know that that will be true this time, but history is this guide. The other interesting thing about the markets right now is that there is a very large disparity currently between what's traditionally known as value stocks, that means lower price to book stocks, versus higher price to book stocks. There is this very wide spread between what is typically known as growth versus value. Tom, do you have any thoughts on how your clients have thought about this recently?
Other than just being disappointed at their lower returns by having value stocks in their portfolio, our client base ranges from people who are pretty sophisticated to people who are relatively uninterested in investing. And we don't always talk about this, but when we do, it does require some education and having people have confidence that if you believe in, say, the equity risk premium, that stocks are going to outperform T-bills. History shows us that the value premium is just as reliable. It just, like stocks, you go through periods where it doesn't deliver, and you just, unfortunately, you have to have some level of faith that something has not dramatically changed. And so our expectation and our clients' expectations is that we will get rewarded for being value investors, sometime in the future.
Yeah, absolutely. I mean, we just know that when you pay less for a dollar of cash flow, then the expected return in the future is higher. And that applies to that. That's why we know that securities have different expected returns. And we know that because if you have a quote unquote riskier stock or bond, then you would expect to get paid more for that over time. So with that, We know a lot has happened in the last 6 or almost 7 months. And we'd like to go into some thoughts around how fiduciaries can start thinking about any changes they may or may not be considering for their portfolios. A lot of churches and dioceses probably are not making any changes, but some may have some folks who are thinking about making changes. And so we want to go through some considerations as your organizations are thinking about that. So first, I'll just introduce it and then I'll let Tom kind of take the reins for this section. But, church assets have a number of goals, and, each diocese, each church, I don't know why I cannot say diocese today. It's like just not rolling off my tongue. Has slightly different needs. And so every pot of assets may need to either fund, new needs that have come about because of the coronavirus, or, it may need to be a stable source of endowment funds. So with that, Tom?
Yeah, okay. Well, why don't we advance to the next slide, Sarah? And I think, there is always a tension between the current needs of any entity and the future needs. And so trying to build a strategy that can support both today and tomorrow is sort of the key thing to what we're up to in really any investment program, but in particular for an institutional investor like a church or a diocese. Go to the next slide. So my main takeaway and my main sort of point of advice to everybody who might be watching today is that times like these that we've just been through and are likely to be still experiencing, for the next few years, really tell me that that there's a dramatic need for discipline, because when the world is sort of chaotic or volatile, for sure, we need to sort of keep our eye on the long term and yet still have confidence that we're going to support the near term. And so having a very clear and cogent investment policy is critical to being successful. I'll put a little plug in for a set of ideas that I know Dimensional believes in, and certainly Diversified Portfolios does, and other companies like Vanguard do. And one of the advantages of having a portfolio made up of strategies that are clearly identified and clearly laid out, like passive mutual funds or index funds, means that you never have to sort of wonder what's going on in those investment strategies. So at the Episcopal Diocese of Michigan, we are all passive and therefore very low cost. And the nice thing about that is we never have to wonder if a manager is going to change his stripes or go off in a different direction. And so we have a tremendous amount of confidence in the dimensional funds that we utilize, and as well as the funds that we use from Vanguard. Go to the next slide.
Oh.
So one of the things that I think that we will hit on here is this circle here that's, I don't know, they probably can't see my cursor, but portfolio liquidity considerations. And I think this again goes to certainly the way that Episcopal Diocese of Michigan is invested. Everything that we invest in is extremely liquid. We don't have any alternative investments. We're, so if we need to raise cash, we can do it very efficiently and quickly. But it really goes to this whole idea of spending policy. And I think that particularly as we go forward, where the bond market is and where the state of particularly US growth stocks, we have to think carefully about what we expect from our portfolios in the future. And that might also inform how much we can spend out of those portfolios. A short mention here also of the SRI circle right there. We're going to talk about this in a future webcast, but as an example, the Episcopal Diocese of Michigan is adhering to the SRI guidelines from the National Church, and so our portfolio is divested of fossil fuels and also does not invest in tobacco stocks or munitions and the other screens that the National Church has put in place. And the nice thing is that Dimensional has some very low cost ways to build a portfolio that adhere to those ideas, and so does Vanguard for that matter. Next slide. So there's a lot of different ways to think about spending. Again, just like having a cogent investment policy statement, I think having a cogent spending policy is also critical. The things that we've done at the Episcopal Diocese of Michigan is we used to have just a straight 5% distribution of a quarter end. Well, it was an annual 5% distribution, which we divide by 4. But we just use the quarter end balance to multiply that by the percentage and distribute that amount. We then, that's going back to the late 80s, early 90s. We started to see the merit in having a moving average. So that's this spot over here. And the beauty of that is when markets are moving up, you are not spending as quickly as you might on those new higher amounts. And it also has the reverse of when markets have downturns like we've had this year, you're not as impacting that recipient as quickly as you might if you were just simply taking a quarter end value. And especially in the Episcopal Diocese of Michigan, we have quite a few parishes that use these funds for human resource costs, and it's tough to lay off people, particularly when they can least afford to lose a job. So we think it's really important to have a stable spending stream so that the parishes can plan. So gradually we've actually reduced our 5% spending rate down to 4.1, and we still analyze that and have contemplated making it even lower. The nice thing is, because markets have risen over the last 10 years, the dollar amount that people are getting has actually stayed about the same. And then we did one more step in the last 3 years where we changed that rolling average from 3 years to 5 years. So that smoothing effect really has a wonderful benefit to helping stabilize that income stream that the end users are getting. Next slide rather. This slide just sort of gets into all these different aspects, and every investor is going to be a little bit different in terms of what they need and how they think about it. But I do think it's up to investment committees to really think carefully about the end user and what they need the money for and how they're getting it. And so spending policy is just something it's like Sarah said in the beginning, we'd like to control the things that we can control. We can't control markets. We can definitely control spending policy. And I think it's really critically important to get it right. Next slide.
That's it.
Yeah, there you go. Quick and simple.
Quick and simple. So I have realized that in this particular screen view, I can't actually see questions. So what I'm going to do is just go through the rest of the slides, probably about 10-ish more minutes or so, and then we will just take questions at the end. Sound okay?
Sounds good to me.
All right. Thanks, Tom. So control what we can control. What I've got here is a couple of pages of data around asset allocations. This is not asset allocations within the Episcopal Church. The reason for that is that, as many of you know, religious organizations are not required to publish much of anything. However, these two data sets, one is from Nukubo, which is mostly higher education endowments. One is from a organization focused on foundations. And really what they show here is the gradual change in asset classes as endowments get larger. Now, most parish and diocesan endowments are probably going to be in the smaller side, so probably in the under $50 million side. So the darker teal green is domestic equities, and you've got fixed income, non-US equities in the bright aqua, and then alternatives in that yellow. Cash and short term is in the top.
And just as a comparison, so we're at about $40 million at the Episcopal Diocese of Michigan. We're about 65% in stocks, 35% in bonds, and we have a breakdown of about 65-35 in domestic stocks to non-US stocks. But we have no alternatives. But I'm sure people on this webcast do. We're just skeptical of there being extra value there, and we're pretty sure there's going to be extra cost.
Yeah, we definitely know there will be extra cost, and I will show some data on that from Common Fund a little bit further down. The interesting point that I want folks to understand here is that the primary drivers of cost within any portfolio of any type are going to be the policy portfolio itself. And that just means, what does your investment policy say you will be invested in? So what asset classes will you be invested in? We know that we can't control markets, but we do know we can control cost. And we also know there's a direct relationship between cost and returns. Now, that said, we live in a capitalist economy, and for better or for worse, usually for better, but depends on the day these days. That said, there's absolutely a place for private capital in our economy. Obviously, we need investors of some type to be investing in private enterprises to grow those enterprises and grow the economy that we all live in. And some of that, of course, is impact investing. So, many organizations will do, 1 to 3% of their assets. Many nonprofit organizations will put 1 to 3% of their assets specifically into investments that are, meant to fulfill a mission of the organization. And so that itself is a different conversation and a different approach, because, you may or may not actually be seeking, returns within that type of asset. We'll talk about that a little bit more in the next webcast. But the other thing I wanted to show here is that, as organizations get larger and they do spend more into alternatives, just know that in the smaller side, so in the sub $50 million side, which is probably most organizations within SEEP, there isn't necessarily a good reason to spend that risk budget in higher cost asset classes. And the reason for that is that there's a lot of manager dispersion from within private asset classes. So whether it's private equity or hedge funds or opportunistic real estate, within public equities, whether it's Dimensionals or Vanguards or anybody else's, there's actually pretty minimal manager dispersion from top quartile to bottom quartile. I saw a slide from JP Morgan a month or so ago on their guide to alternatives, and what they were showing is there's a trend line that roughly over the last 10 years, equity-like investments have returned, call it 10 to 11-ish percent. That was as of the end of May. What we see is that the top quartile to bottom quartile managers within public equities have a dispersion of between 200 and 250 basis points. So the best ones were 200, 250 basis points higher than the worst. when you move across and you look at private equity, hedge funds, opportunistic real estate, their average is about the same as public equities because it is an equity-like investment. But their manager dispersion, the top to bottom quartile, ranged between 11 and 20%. And so that just means that, being able to pick that manager is really, really hard.
Well, we should just pick the ones that do better, right?
Absolutely.
It's easy to know after the fact.
Easy to know after the fact. So, that's why, we really think that particularly in the smaller space, yes, if all of your portfolio is in more liquid investments, then you will see, day-to-day changes. However, private investments are having those same valuation changes. They just are not valued as frequently. And so therefore you just don't see it on a day-to-day basis.
You can see your house change on Zillow now, but it doesn't change quite as quickly as.
Right.
Yeah.
I have found out that I am much richer than I was 18 months ago when I bought this house.
Good job.
But who knows?
Right.
Change. All right. So this is the same information, just it's the foundations across the U.S. So when we talk about policy portfolio, so I know these bars are a little funny. So this is just index data from Professors Fama and French. It's not dimensionals fund data. These are just indices that are built to show on the left 100% fixed income, all the way over to the right 100% equities. So when we think about control what you can control, of course it's relatively intuitive that the higher your allocation to equity, the more volatile your portfolio will be. So this just shows you that in a numerical format. As you can see, annualized returns over the last 35 years or so do obviously tend to go up, but so does the standard deviation, so does that volatility. Of interest though, I didn't include this, but the NACUBO data on endowments, which is again mostly higher education endowments, mostly following the endowment model, their average standard deviation tends to hover around 11, as does about a 60-40 globally diversified portfolio. And so, having that, yours is 65-35, most organizations is going to be something between 50-50 and probably 70-30 in terms of equity and fixed income / cash. And in general, if you've got a low cost portfolio, you're probably going to have roughly the same standard deviation over time.
And the beauty and practice of that balanced portfolio, I mean, like, I think Jack Bogle famously said, you can't eat risk-adjusted returns. So we sometimes focus on this standard deviation question, and we want to lower it but get the same return and increase our return per unit of risk. But at the end of the day, we just need dollars, right? So if we can get a higher return, we're going to be better. But I think there's something that really showed up this year quite nicely, which is when you have a balanced portfolio and you're part of maybe what we're not saying is that when we own bonds, we want to own bonds that are high quality. So like we saw it in the bond sheet that you showed us, the higher quality bonds went up quite a bit in the first quarter. And so, there you are with now all of a sudden stocks down, bonds up, and you got to make a distribution. Well, what do? You sell bonds, right? That's rebalancing. And so this first quarter and now the second quarter, we did the reverse. Particularly when you don't have to worry about taxes, it's a beautiful thing that you can sell the asset that's gone up right when you don't want to sell the thing that's gone down.
Yeah, absolutely. I won't spend any time on this. Again, this is just index data. It's essentially, how much would you put into the US versus international, developed versus emerging markets, real estate, tips, short-term, long-term government, and investment grade fixed income. So if you were looking to build just a plain vanilla, 40, 60, 60, 40, 50, 50, something like that, from any sort of, liquid options, this is approximately the percentages that you would consider. All right. The last major thing I want to talk about is costs. So this is the big thing that we think fiduciaries should pay really close attention to. It is from Common Fund. They published a paper called Counting the Cost a couple of years ago. It is super interesting, and once the slides go out after our compliance department approves them, approves the recording for distribution, then y'all can just click on that link and read the paper if you'd like. It's not that long. I think it's like 8 pages, double spaced, so it's not too bad. But what I want to show here is the dispersion of costs and how organizations can actually count how much they're paying and therefore the drag on returns. So this is Common Fund slide, so I couldn't edit it at all. But what I see is that they bucket their organizations into sizes, and because they know roughly how much organizations pay, they have within each bucket the expected column, and then they have the reported answers from the organizations, and then the difference. So that's why you see this E, R, and D. So the expected column is probably the most likely to be the truest number, just because it is based on not just what folks have reported, but based on how Common Fund is also calculating what they know things to cost across a larger sample set. So this top line is just direct fund asset management fees and expenses. So as you'll notice, smaller organizations tend to have lower direct asset management fees, so 52, 61, and kind of the under $50 million market. And then as you get larger, they tend to have higher asset management fees. This is really just a correlation between complexity. So as organizations get larger, they tend to be more complex and tend to have more complex types of funds and vehicles, so more private funds. Then you've got fund and operating expenses. These are going to be higher on the lower end because it just costs more human capital time to put together portfolios. So that subtotal right here, so call it 90-ish basis points, that's just for the basic fund expense on average. Then fund-of-fund fees. This is incredibly hard to calculate because, and it varies a lot. These are mostly private contracts. So if, for example, a smaller endowment or foundation wants to invest in, say, a hedge fund or a private equity manager, often they will get that opportunity through what's called a fund of funds. And the fund of funds manager will then go and find the underlying managers for the fund. And so there's typically a wrap fee on top of that. And typically those are higher when you have a smaller asset base and lower because you can negotiate it with a higher asset base. So that brings the total of fund cost and direct costs to something like 120 basis points, so 1.2% roughly. This does not include two things. It does not include any incentive fees. So for example, hurdle rates, or other incentive fees that are paid to private equity or other types of private asset managers. Those most common fund thinks that on average, they probably net out around 40 basis points. However, there's a ton of dispersion between like 5 to 75 basis points for those incentive fees, quite simply because they are, again, individual private contracts between the organization and the manager. So call it 120 or so basis points of expected direct fund cost. And then they will have either a advisory or OCIO fee. So roughly call it mid 30s, in one of those two. So 150 to 160 total basis points.
And just to give a flavor for the dimensional and diversified portfolio way, the total costs at the Episcopal Diocese of Michigan, including the advisory fee that my firm charges, is 25 basis points. So
lower.
Yeah, 1/4, basically, less than 1/4, 1/5.
Yeah, I mean, you guys are definitely on the low end.
We are, but that we love Episcopalians, so we want to do it right.
Right. So I would say what I have seen across, many hundreds of organizations is that it is not usually that low. I know that, Tom, for you personally, I think you're just giving back as part of it to the organization that you were personally involved in. If you were to go to, Joe Schmo, broadly diversified advisor, for whom we have 3,000 and can connect you, to, if you need one, you're probably going to pay something like this, 30, 35-ish basis points for the advice. And that's going to be, for investment policy and spending policy and all of those things. And then a truly broadly diversified portfolio, if it's, Dimensional, if it's Vanguard, if it's, whoever that is low cost, is probably going to be somewhere around 25 to 30 basis points total. So I would say, soup to nuts total, you're probably looking at 60 to 75 basis points. So still half.
Yeah, still something in the range of half if you're paying attention.
So that is about all I've got. I will share these slides out with everybody. And if anyone wants to ask any questions about these types of costs, if we don't have time for them during the webcast, we're happy to talk about them offline. And the final thing that we want to impart to fiduciaries is that if you are thinking about, many churches already have an advisor. Some churches don't have an advisor. Maybe they've got a church member who is just informally serving in that space, which is obviously a very, wonderful service for them. If you do need an advisor, these are the types of questions that we suggest people asking. And of course, during this type of market environment, it's really important that you feel the advisor matches up with your risk tolerance and asset allocation and cost. So with that, I'm going to stop sharing my screen. And I think I see a couple of things.
Yeah, it looks like we've got a couple of questions.
All right.
I'll let you, let's see. Somebody was asking, saying that dimensional fund fees are typically 40 to 60 basis points, but many index funds are now in the 10 basis point range. Do the returns on DFA funds justify the additional expense?
Yeah, so I'm sorry, it's a Benji? I'm sorry, I don't know how to say your name. I think it's Benji. So that is true about some asset class funds. So say US small cap value, emerging markets, small, but for core portfolios that are total market, they are, when you weight out the entire portfolio. So if you have a 40, 60, 50, 50, 60, 40, 70, 30, the entire portfolio across equity and fixed income will net out probably around 25 basis points. And that's because a core market-wide portfolio has much more efficiency because it doesn't trade as much, it doesn't need to trade as much, and because they're very large and quite similar to index funds. We are not the cheapest, absolutely. Vanguard, in terms of explicit cost, does have lower expense ratios. There is a lot of data about pure index funds versus a systematic approach. Honestly, it's just a tolerance difference. So earlier in the slides, we showed the big disparity between growth and value. So right now, if you hold a pure market portfolio, you're much heavier on the growth side, which means that recently you've experienced that positive upside. However, there are differences in market returns depending on what segment of the market you're in. And so if a organization does want to pursue higher expected returns, if you want to take on additional risk that's not just a market portfolio, then you have to consider small and value as part of your portfolio. But some organizations don't want that. They just want pure index. And so Vanguard's probably the way to go. That's what you want.
Yeah, and in the portfolio we run for the Diocese of Michigan, we have both. First of all, we have the social screens, and so we have both Vanguard SRI ETFs as well as dimensional sustainability funds. And over the long haul, since we've been investing with dimensional, our clients have been rewarded by being invested in them relative to lower cost options. So is it worth it? Yeah, our experiences, it's been worth it. But we even in our non-SRI portfolios, we always own a huge slug of total market, and we do that through Vanguard because it's the cheapest way to do it. So it depends on client preferences and strategies. Somebody was asking, Rich Stein was asking, what are the total assets of the Diocese of Michigan? It's roughly right around 40 million right now. And about, I want to say, a third of that is the diocese itself, and then the remaining 2/3 is member parishes throughout the diocese and some other Episcopal organizations that are inside Southeast Michigan.
Great. That is all the questions that I see. If anybody has anything else. Oh, thank you, Benji. I'm glad I pronounced your name correctly. It looks like we may get a few more minutes back in our day, which is great. The last thing I'll share is my contact information. I will also, if anyone emails me, I'll make sure you can get to Tom. I think Joe may put our contact information out here as well after the webcast. That's not my, it's not my.
Yeah, and I think both of us are happy to be sounding boards and free consultants to people who are tackling some of these issues that we covered today, and examining cost structure, trying to figure out how to put a cogent investment policy statement together, or what is a proper spending policy. Those are things that we think about and work on constantly, and we're happy to be a resource on those types of matters, let alone all the investment related things that we talked about.
Yeah, absolutely. We can do portfolio analysis, and the other big thing is that Tom again is one of about 3,000 advisors that we have connected to, and we do not have any formal financial relationships between us and our advisor clients. So typically what we do if someone is looking for a second opinion or some additional advice is we'll give you 3 to 5 names, some local, some national, and you can go ask them whatever you'd like to ask them and see if they are a good fit. So with that, I think we'll wrap it up. So I think I did see potentially one more question. Oh, looks like Joe just sent it out to everybody. There is a survey, so check out the Survey Monkey. We would love your feedback because
Yeah, please do.
it's our first time, and hopefully, I think we'll be doing it again in about 2 months. I'm focused on the ESG SRI conversation.
Yeah, that'd be great.
With that, be well, everyone.
Thank you, Sarah. Good job.
Thanks,
Talk to
Tom.
you
You too.
All right.